What is going on, Future Folks family? My name is George, and we talk about investing on this channel. And today, I wanted to talk to you about what's going on in the market and what's going on in the housing market as well, because rates, as we've been talking about this whole week, last week, the rates are on a tear right now. They're rising a lot. And we're going to talk about why it's important. We're going to go through a few articles that are addressing it to try to give us a better understanding of how to invest if you are going to invest in a house. We're going to look at the stock market and try to identify why the stock market is doing what it's doing the last few days, which has been on a decline. Before we get into that, the reason, my perspective has been for the last few weeks, if you've been paying attention, that the reason the market is going down the way it's going down is because we were already in a bear market. So the last 3 weeks, when we were, green day after green day after green day, that was just what we call a bull trap, which means that you feel like the market is going to continue to go up, and then people get more confident and they start investing in the market, and people get caught. Next thing you know, you wake up one morning and then the futures are down, or you wake up or you're about to go to sleep and you see that the stocks were down that day. However often you look at your portfolios, but crypto's doing the same thing, and a lot of it is tied to what the Federal Reserve has announced, and they're going to be a lot more hard to try to get us back in the shape that we need to be in. We need to fight inflation, and we need to pay back a lot of debt. And in order to do that, they need to do something called monetary tightening, which they're going to tighten monetary. They're going to put constraints on the economy. And one of the things I want to talk about tomorrow or Monday is going to be stagflation, and what effect stagflation could possibly affect. Before we get into all that, as always, we're going to get into what the market is currently doing right now. So right now, the Dow is down 0.057%. The S&P 500 is down 0.18%. You have the NASDAQ down 0.19%. The global Dow is down 0.49%. You have gold and silver, which are slightly up, which is good to see the anti-correlation there. I like to see that. Let's talk about crypto. Um, Crypto, you have Bitcoin, which is down 1.09% underneath that crucial level of resistance, which is 45,000. So anywhere right now, we could be in a funnel anywhere between 38,000 and 43,000. So just keep an eye on for that. If we surpass 45,000 and hit 50, then that's going to be bullish. If we go underneath 38 and go to like 35,000, 33,000, that's going to be very bearish. So there are a lot of catalysts that are going on there. Ethereum is down 1.8%. XRP is down 0.26%. You have Litecoin, Bitcoin Cash, both down as well. And Monero is down 0.50%. One of the things I do like to look at is, as a forward indicator, is how Asia is doing. How the Asia markets are doing. And as you can see right now, the Asia Dow is down 1.49%. The Nikkei 225 is down 1.169%. The Sensex is down 0.97%. And remember, these are in the future. Like, their markets open before ours and they close before ours. So this is one of the things I like to look at, as well as Europe, but not so much Europe. Asia is one of those that I look at as a forward indicator of what potentially can happen. Another one that I look at is the Australian index, which is not on here, but just to keep you in mind. Let's see what the rates are at. That's important to look at. So the United States 10-year is at 2.65%. It's up 5 basis points. And the UK 10-year is up 0.29. The Japan 10-year, which has not been positive at all, they're like really on a decline right now, which would be great if you were in Japan or looking to invest in Japan and take out some debt in Japan. Right now would be a great time to do that, because they are, at least a great time to start looking at maybe investing over there, because they are about to hit a recession very, very soon. And you can look at recessions in good ways and bad ways. Yes, it's negative that they're going through that. And, if people are suffering, that's always a negative. But in a positive sense, if you prepare yourself for it, then you could take advantage of these opportunities. And the purpose of this channel is to tell you about these opportunities. So if you find any opportunities that you think will help out the community and help us all out as a whole, let us know. We appreciate knowledge like that. Let us know in the comments below. So let's talk about it. Let's talk about the S&P 500 and how it hit a death cross and why it's good news for the stock market. So what a death cross is, I'm not sure if this article will get to it, but a death cross is whenever there's two moving averages. You have the 50-day moving average and the 200-day moving average. And anytime the 200-day moving average goes underneath the 50-day moving average, that's when you have a death cross, and that's historically been a negative for the stock market. So the S&P 500 has performed so poorly this year that it is now trading at a scarily low level. That usually presents an attractive opportunity for longer term investors. The market benchmark down about 12% for the year hit a death cross on Monday. That's when the index's 50-day moving average falls below the 200-day moving average, like I said. It's a signal that something is up in the market. If anyone needs more evidence in normal times when stocks are rising, the average percent of recent prices is higher than the figure for 200 days because the longer term number includes levels when stocks were lower. Stock prices have fallen below their long term trend as investors consider the current formidable risk to the economy. The Russia-Ukraine war has led to sanctions on Russia's commodity exports that have reduced the amount of those goods on the global market, sending prices through the roof. Consumers could pull back on spending as a result. Even before Russia's attack, inflation was taking off, putting pressure on central banks. Although that makes things in the stock market feel bleak, it is probably a good time for long-term investors to buy stocks. Historically, the S&P 500 tends to post gains in the 12-month period following an initial close in a death cross, based on the 53 times the index has closed in a death cross. So keep that in mind. 53 times that the index has closed in a death cross territory, the average gain over that span has been 6.3 according to the Dow Jones market data. It doesn't say it here, but this has been true 80% of the time. So 80% of the time when there has been a death cross, 80% of those times, the market has been up in the 12 months following. So according to FundStrat's research, gains occur about 2/3 of the time historically for the 12th month after the death cross. When losses occur, it's often just before a recession. In November 1929, the index entered into a death cross before dropping 23.5% for the following year. In December 2007, the index entered the territory and subsequently fell 41.5%. The point is that at some point, the macroeconomic risk that sends stocks lower becomes fully reflected in their prices. And as long as corporate earnings are still growing, stocks will resume rising at some point. This is a correction that the average gain in the S&P 500 in 12 months after has been 6.3%. An earlier version of this article said the gain was 15.7%. So what do we get from here? So what are our takeaways? What's the importance of this article? So the importance here is to know that I know we hit a death cross, but historically it's been optimistic 12 months later and the market has recovered. So that ended up being a buyable dip whenever that death cross occurred. However, it has not been the case prior to a recession. And where are we now in a macroeconomic look? So with the Fed raising rates, with inflation at an all-time high, mortgage rates at an all-time high, fuel rates at an all-time high, we are now primed to be in a recession territory. So what does that tell you? That if history is an indicator, then right now it would indicate that this cross means there is a lot of pain and suffering to come in the stock market as a whole. So just think about that. As a long-term investor, what does that mean for you 5 years, 10 years down the road? I would think that depending on what you're investing in, because not every single stock or cryptocurrency is going to give you the same outcome 10 years from now. Some of those may not even exist. The way to look at it is that if you're investing in companies that are making profits, so they're currently making money, it's going to be good for them. A lot of these companies that have a lot of debt and they're not really generating income, which means they're making money, but the money they're making is not enough to pay all their debt, pay all the like everybody that works for them. And if they're giving a dividend, give a dividend to their investors, then these companies are going to end up going under. So these are not the companies that you want to be invested in. All right. These are very speculative companies. And although there is going to be companies that go 100, they go up 100% and you double your money. The amount of them that this is gonna happen to is gonna decrease very, very expeditiously in a recession period. So that's something to keep in mind. All right. So let's keep going. We'll go to the next article. So the stock market is behaving a lot like it did during the Iraq war. Here's the future if the pattern continues. And the reason it's relevant is because, as you know, right now, currently, Ukraine is kind of going through a similar situation. And in a macroeconomic sense, it affects the entire globe. So the Iraq war of 2003 doesn't have many parallels to Russia invasion of Ukraine, other than perhaps the global unpopularity. There seems to be at least one parallel how stocks have behaved as the charts show. So just look at this chart here. This is the textbook recovery from Ukraine invasion so far. On the left, you have the performance index day of mission equals 100. So how many 100 days? And then trading days. So this is how the market has reacted to it. You have the S&P 500 in green, and you have the S&P 500 during the Iraq war. So you could see how the S&P 500 similarly acted back then as it is acting now. All right, so that's very important to look at. Um, Investors are still pessimistic towards stocks in the UK and Europe, and while the US measure has recovered, it has peaked due to inflation concerns. So it hit a top. This right here is the GMO commodity index, and as you can see, it's been on a decline, and ever since 2000, we've been on an incline. Although we've hit some, it's been choppy waters. It hasn't been that great in the period from 2012 until 2020. It was very like core. There was a consolidation period that was like if you had money invested in gold or silver during this time, it was not the happiest time for you. With commodities in the spotlight, it might be worth taking a long-term perspective. An equal weighted index of 36 key commodities had a 100-year trend of declines before reversing. After the year 2000, the trend changed and prices began to rise under the pressure of unrelenting growth in China, whose global share of important commodities such as iron ore, cement, and coal rose to 50% by 2013 from around 5% in 1980. All right, so something to take a look at that. And so that's the stock market for you. That's how the stock market is acting. We talked about the death cross. Let's talk about mortgage rates. So mortgage rates climb higher again, and the rapid rise in mortgage rate isn't stopping, with the rate on the most common loan hitting the highest point since December 2018 this week. The rate on the 30-year fixed mortgage increased to 4.72 from 4.67 last week, according to Freddie Mac. The rate had climbed nearly a full percentage point since the first week of March and is up 1.5 points since the start of the year. It's also the fastest 3-month rise since May of 1994. For real estate markets, the sharp jump in mortgage rates over the past quarter indicates a decisive turning point, said George Ratoy, Realtor.com's manager of economic research, in an emailed statement. For many Americans, families today's mortgage rates are closing the door on being able to afford to buy a home this spring. So this is the mortgage rates climbing higher. This is the 30-year fixed rate mortgage average in the United States. So if we take a look back at the year like 2000, this is how high rates were, 8.64%. As you can see, we hit a decline. We kept going down, We bottomed down here around 2.66, but we are currently back on the rise, heading back to 5%. I could see 4.94% being that next level of resistance. All right, we're going to talk about what's a rate that you should be worried about. But what's driving up? What's causing this? All right. So fixed mortgage rates tend to follow the yield on the 10-year treasury, which surged to 2.6 earlier this week, the highest level in 4 years. as investors fled bonds on expectations of higher interest rates. Investors are digesting the week's remark by a number of Federal Reserve presidents, which echo Chairman Jerome Powell, stated concerns that inflation is on an aggressive path, which threatens to derail the economy by cutting consumer spending. So let's look at this other article, which is correlated with this. So mortgage rates are surging faster than expected. The average rate is 4.72, like we just covered. And most estimates at the end of last year had the average 30-year mortgage rate on their home at hitting 4.5% by the close of 2022. But the war in Ukraine and raising oil prices and inflation have all lit a fire under interest rates. At this time in 2021, rates were about 3.45. A shift in the policy outlook for the Federal Reserve, suggesting far more rate increases than expected, is pushing bond yields higher. The 30-year fixed mortgage loosely follows the yield on the 10-year Treasury rate. So this is a direct quote. Rates have a small chance to top out before hitting 5% and a good chance of topping out before hitting 6%, said Matthew Graham, Chief Operating Officer at Mortgage News Daily. It is a rapidly moving target in this environment. We're legitimately and unexpectedly find ourselves needing to be concerned with inflation for the first time since the 1980s. All right. So, what is a rate that would cause fear in the hearts of investors or that you should be worried about? So, this article here talks about it. How do mortgage rates, how high do they need to climb before it's time to worry? And UBS, they say it's above 5.75%. But don't expect a 2008 style meltdown in housing, even if interest rates on the benchmark at a 30-year loan hits that level. The reason they're kind of saying not to worry about it is because back then there was a lot more consumers like you and me, like regular retail buyers of houses that were the ones that owned a lot of the properties. But there was a big shift in that back in 2000 when the whole housing crisis happened, the financial crisis of 2007, 8, 9. Uh, a lot of big companies like BlackRock took advantage and they bought like 80% of the houses on the market. So that's something to keep in mind. Right now, they're like renting a lot. They're like net renters. So one thing you need to keep in mind is that they're not going to panic sell like a lot of people did back in those days, like regular guys just like you and me, girls just like us. They did that. So um, don't expect the same type of thing to happen this time because the people who own a lot of the houses not now are those big corporations who aren't gonna like just panic sell for loss like a lot of us did. But the reason you should be concerned is that there is a lot of retail investors out there. I know they're kind of contradicting, but just keep this in mind. There is a lot of retail investors out there that bought something called an adjustable rate mortgage, which means they bought hoping that the rates would continue to decline and they would benefit from that. However, the opposite has happened. So a lot of those that bought with a 2.5% on a 30-year mortgage, now they're paying 4.67%, which is an increase of about $300 per month, depending on the loan. But on average, that's what it is right now on a $350,000 home. So just keep that in mind. Like these people are paying a lot more than they expected to pay, and if it goes to 6%, like if it doubles, they're going to be paying maybe 5%, $500 a month more than they were expecting to, and this could have a big implication on people being forced to sell their homes or go into foreclosure, or some stuff that I like, which is called a short sale. Which is a better way to buy a house to me than a foreclosure. It takes a longer time, but I think the wait is worth it. But we could address that in a different video. Um, Grocery, gasoline, and housing prices have shot higher. We already know that. It becomes a greater concern if the 30-year fixed mortgage rate exceeds 5.75, said UBS's Salita Marcelli and her team in a Tuesday client note. Reaching that threshold would require at least another 1% increase in the benchmark 30-year fixed rate mortgage from its 4.67% average at the end of March. The analysis by Marcelli, Chief Investment Officer in Global Wealth Management, and her UBS team also assumes mortgage rates heading towards 6% would come as home prices flatten out after 2 years of upward spiraling. As part of this, Marcelli's team pegged monthly mortgage rates nearly 50% higher since December 2020, with the median price of existing homes rising roughly 20% during that span. So just keep that in mind. All right. So, what does this all mean in a nutshell? How can we consolidate all of this information to best help us? Well, always, no matter what it is, whether it's a stock, cryptocurrency, the housing market, oil, anything, whatever it always overshoots on the way up, whatever the price is. That's why there's always something called a correction, which means things come down over 10% in order to correct the price, because things always overshoot to the top and they always overdrop to the bottom. And that's why you have long periods of time to buy and when things go down. But whenever they overshoot, you don't really have a long time to sell at those all-time highs because it happens really rapidly before things drop, and they drop out of nowhere unexpectedly. So it's not always a good strategy to try to pick tops and sell at the top and then find bottoms and sell at those bottoms, because you might end up losing a lot of money in the long run when you could have just sold at a price that you felt comfortable with and bought at a price that you felt comfortable with. That's been a good strategy. You're not always going to be perfect. Sometimes you're going to buy and then things drop a little bit more. But have a strategy for when that happens. All right. Sometimes you're going to sell and see that whatever you bought keep going up, and you have to have a strategy for things like that. You can't be emotional about whether you're buying or selling. So what can happen? So if a lot of people start going into foreclosures, or even before that happens, if the rate of home purchasing declines, what's going to happen? That means demand decreased, which means with the amount demand decreasing, the prices of these houses are going to subsequently decrease as well. And that may happen more rapidly than you think. And the reason I say that is because in the last year, people were overpaying for houses by a lot. They were overpaying by 30,000, 20,000, 50,000. And they were literally paying more than the person had the home listed for, just because they had the fear of missing out and they really wanted a home. Everybody's convinced they needed a home at that moment, and they were willing to pay whatever they wanted to pay for it. So a lot of those people inflated the market a lot, which is called a bubble. They created a bubble. If prices go down because the mortgage rates have risen so high that people aren't willing to pay that interest rate for houses, then that can make prices go down. If the adjustable rate mortgage that people were paying 2.25 goes up to like 7%, 8%, this is going to force a lot of people to go into foreclosure, which is going to put more supply in the market, and thus that increase in supply with that decrease in demand is going to make house prices drop a lot. This could play out over the next year. This could play out over the next 3 years. It's all a wait and see right now. But right now, we're at all-time high inflation. We're at all-time high unemployment. Employment, which means there's more people working in the workforce right now than ever before. The unemployment level is dropping every single month since the pandemic. That is going to lead to something called stagflation, which means the economy is still growing while the amount of interest rates are all rising and everything's getting more expensive. Inflation is rising. So we'll talk about inflation a lot more. I don't want to get too much into it in this video, but I hope you guys enjoy this content. I'm trying to give you the best content possible. If you have not hit that like button, please hit that like button for the algorithm. Subscribe. It costs you nothing. All right. So as always, invest in me and press that like button. Invest in yourself and smash that subscribe button. It costs you nothing again. Until next time.